In the previous episode, we established that the contribution structure drives the cash flow outcome. We showed how recurring surplus generation, contribution margin, and structured discipline ultimately improve cash flow from living, liquidity accumulation, resilience, and optionality. But eventually, a critically important question emerges. What should the surplus actually do? Because surplus sitting idle indefinitely is not the ultimate objective. The purpose of stability is intentional future state construction. And this is where cash flow from investing begins to become critically important. Cash flow from investing represents the deployment of surplus toward future capacity creation. This includes retirement investing, education, skill development, productive assets, business investments, real estate, and other future-oriented capital allocation decisions. Conceptually, cash flow from living creates operational flexibility. Cash flow from investing creates future state expansion. This is one of the most important distinctions in adaptive financial architecture. Because survival alone is not enough, strong systems eventually transition from stabilization toward intentional compounding. One of the deepest ideas in finance is this: maximizing short-term cash flow and maximizing long-term value are not always the same objective. This creates an unavoidable trade-off. For example, a household can avoid investing, delay education, postpone maintenance, eliminate retirement contributions, and preserve maximum liquidity today. Short-term cash flow may improve dramatically, but over time, future optionality may weaken significantly. This is critically important because underinvestment creates strategic fragility, and strategic fragility often develops slowly and invisibly. Many households appear operationally stable today, but structurally they may be, and oftentimes will be, strategically underinvested. Examples include no retirement investing, no emergency reserve growth, no skill development, no productive asset accumulation, or chronic consumption dominating capital deployment. Operationally, the system survives. Strategically, the future weakens. This distinction matters enormously because stability today does not guarantee adaptability tomorrow. Strong systems therefore benchmark not only liquidity and recurring surplus, but also future state funding capacity. One of the most important distinctions in adaptive financial architecture is productive deployment versus consumptive deployment. Consumptive deployment primarily creates temporary lifestyle enhancements. Productive deployment creates future income capacity, future optionality, resilience, and long-term adaptability. This does not mean all consumption is bad, but structurally, strong systems intentionally prioritize productive compounding systems. Because productive assets generate future flexibility, reduce dependency, and improve adaptive capacity over time. At its core, cash flow from investing is really future state engineering. It answers questions like what future is the system building, what optionality is being created, what productive capacity is compounding, and how adaptable will the system become over time. This is why investing is not merely wealth accumulation, it is adaptive capacity construction. Strong systems intentionally deploy surplus toward resilience, productive assets, flexibility, and future strategic freedom. At this point, adaptive financial architecture begins evolving into future state benchmarking, because eventually the household must answer questions like, what future are we attempting to build? How much capital will that future require? What monthly investing capacity is necessary? And what recurring surplus must the system generate to support those goals? This is where cash flow from investing becomes one of the most strategically important sections of the entire financial system, because this is where intentional future engineering begins. The strongest strategic households often begin with the future state target itself, not current consumption or current lifestyle. Instead, they begin with desired future flexibility, retirement goals, optionality targets, location freedom, business ownership, education funding, passive income objectives, or financial independence pathways. Then they work backward. This is critically important because once time horizon assumptions, return assumptions, inflation assumptions, and future capital requirements are estimated, the household can begin calculating the required recurring investment flows necessary to reach those targets. This dramatically changes the structure of decision making because now the investing benchmark determines the required recurring surplus. And the required recurring surplus then influences lifestyle decisions, housing decisions, leverage tolerance, subscription expansion, vehicle purchases, and fixed cost structures. This is a major conceptual shift. Instead of asking, how much can we consume today, the system begins asking, what level of recurring surplus generation is required to build the future we actually want? This is why strategic households often look very different from highly consumptive households, because future state engineering requires intentional capital deployment, controlled lifestyle expansion, and recurring investment consistency over long periods of time. Strong systems therefore benchmark required investing rates, required surplus generation, liquidity reserve targets, and contribution structures against future state objectives. This is one of the deepest ideas in adaptive financial architecture. The future is not discovered accidentally, it is benchmarked, reverse engineered, funded, and constructed systematically over time. And this is why cash flow from investing is not merely an investing section, it is really the future state construction engine of the household operating system. Once future state investing requirements are benchmarked, the household begins realizing something critically important. Every dollar committed elsewhere affects future optionality. This changes the entire architecture of decision making, because now housing costs, vehicle purchases, recurring subscriptions, lifestyle expansion, and leverage decisions must compete against future state investment flow requirements. This is where strategic households begin behaving very differently from reactive households. Reactive systems often consume first, then invest whatever remains. Strategic systems often benchmark required investing first, then structure the operating system around those targets. This is one of the biggest conceptual shifts in adaptive financial architecture. The future state benchmark becomes the anchor for recurring surplus requirements, liquidity targets, and acceptable fixed cost structures. At this point, the recurring surplus ratio becomes even more important because now the household is no longer benchmarking surplus merely for stability or liquidity preservation. Instead, the recurring surplus ratio now determines whether the system can realistically fund its future objectives. This is critically important because many households appear operationally stable while simultaneously being strategically underfunded, meaning retirement targets are not being funded, investing capacity is insufficient, future optionality is deteriorating, and long-term adaptability weakens gradually over time. Strong systems therefore benchmark required recurring surplus generation against future state investing requirements, liquidity reserve targets, and uncertainty buffers. This transforms recurring surplus from a defensive metric into a strategic future engineering metric. One of the most powerful variables in adaptive financial architecture is time horizon, because longer time horizons dramatically reduce required monthly investing pressure. This is one of the greatest advantages available to strategic households. Small, consistent, recurring investment flows, sustained over long periods, can compound into extremely large future state outcomes. This is why strong systems prioritize consistency, repeatability, and structural sustainability. not aggressive short-term optimization, because adaptive systems are designed to survive long enough for compounding to work. This is critically important because many fragile systems fail not from lack of earning potential, but from structural inconsistency. Ultimately, the deepest purpose of investing is not merely wealth accumulation, it is optionality expansion. Strong investing systems gradually increase career flexibility, geographic flexibility, time flexibility, income independence, and strategic freedom. This is why the strongest strategic households often focus less on appearances and more on future flexibility, because optionality itself becomes a form of wealth. And strategic investing is one of the primary mechanisms through which adaptability, resilience, and future freedom compound over time. At this stage, the household operating system has evolved significantly. The system is no longer merely reactive or survival focused. Instead, it becomes strategically engineered. The future state target determines required investing flows, required recurring surplus, acceptable leverage, liquidity requirements, and structural operating constraints. This is why benchmarking becomes so important, because without benchmarks, consumption expands reactively, investing becomes inconsistent, and future optionality deteriorates invisibly over time. Strong systems therefore define the future, reverse engineer the requirements, benchmark the structure, and then systematically fund the path. In the next episode, we move deeper into strategic capital allocation. We'll examine productive versus consumptive deployment, opportunity cost, strategic prioritization, and how capital allocation decisions reshape future adaptability over time. Because once the future is benchmarked and the investing requirements are known, the next question becomes, where should capital be deployed first?